Hey, good evening.
Good
Good
evening,
evening,
Professor.
Professor.
Hey, good evening. How are you, and Anthony? How are you, Anna? Well, I don't know if it is my internet or Blackboard, but the Blackboard is extremely, extremely slow tonight. I don't know if it is Blackboard problem or my internet. It's taken so much time. It took ridiculously long to load. This is ridiculous, really.
Glad you
Um,
made it.
yeah, yeah. Well, I made it. uh, so let me okay share my screen. So it took almost 10 minutes to get connected. So I have five people, and this is we have only like three more classes left, and this is so disappointing that I have only but a few good people that hang in there tough until the last minute. Let me just check how many people are in. See, it's taking such a long time here. You see, it's circling this. Hmm, give me a break. Okay, so I see at least nine people. Nine people. So I'm just hoping four more people will join us. Yeah. So in our last class, we were, we started on the duration. Okay. So and we did this exercise in duration because duration is the weighted average of um, each time period weighted by the present value of each um, coupon payment out of its present value of the bond, right? We did that example, and that's only one way. That's only one way of. Okay, so let me also open this one. I must have it here too. Expression. Okay, so we did this exercise last time. Duration may be a difficult concept to grasp, but not really. As I said, so what is duration? Duration is um, effective effective maturity, right? In other words, although the maturity of the bond may be 10 years, right? If your coupon is high, if your coupon rate is high, and if the discount rate or if the discount rate or the yield to maturity is low, then most of the you recover. I mean, you recoup your investment early on, right? All those early coupon payments. If the maturity is 10 years and there will be 10 coupon payments, a lot of the present values of those coupons are mostly centered towards the earlier part of the years, earlier part of the timeline, right? In other words, uh, the coupon rate is high, so you are collecting high coupon interest, and the present value of them are mostly present value of them are high because discount rate is low. So then most of your um, present values are accumulated at the beginning. Of course, the present values of uh, the coupons, and then of course at the maturity you will have the par value, the face value. It will get discounted, of course, um, but then still because the discount rate is low, then you have a huge hefty present value of that face value. Then that means it doesn't you don't need to really wait um, 10 years to fully recover your initial investment because with the present values being mostly uh, mostly coming from the early coupon payments, right? The big chunk of the coupon payments present value, a big chunk of the present value stem from the earlier coupon payments. So you have pretty much recouped most of your initial investment early on. So it doesn't have to take 10 years. Maybe by year 7, you have fully recovered sufficiently your initial investment. So that's called duration. Duration is effective maturity, and how we find duration, how we calculate duration, it's literally the weighted average, right? So last time, so if you were here last time, we did this exercise. We don't, I don't want to do it again because it's gonna be, but look, what's going on here? We are finding present values of all of these, and we find the weight, and you sum all of those present values. That's the value. That's the rational price. That's the fair value of the bond. Right? Makes sense? I'll have to show.
Yes, I
Ah,
saw the recording. I was following the recording.
good.
It
Very
was,
good. Very good.
yeah.
Yeah. Very good. Um, so then, with this being the denominator, we can find the weight of each of the payments, and then this being the weight, and we multiply it by the time period, right? Time until the coupon payments, right? Uh, we find these, weighted average, weighted time periods, right? In other words, you don't have. That means if the weight is um, high, right? Uh, uh, the weight of the first year in the total duration must be big, right? And so on, right? And then if you add them up, that's the duration, that's effective, right? Maturity. Um, and I also told you that the zero coupon bond duration of the zero coupon is the same thing as the maturity. There's no difference because there's no coupon payment. Okay, but the duration can also be calculated. Okay, where I put it here. Duration can also be calculated this way. Duration is like elasticity. What is elasticity? Price. Let's think about the price elasticity of demand. What's the price elasticity of demand? Um, And microeconomics, you must have taken microeconomics. If you're all finance majors, must have taken. So how sensitively does the demand react or respond to the change in price? So we know that the elasticity is basically a negative number, and elasticity is basically uh, change in price. Okay, change in price over price. So it's the percentage change in price, percentage change in price, and then no, actually in elasticity it's going to be percentage change in demand, quantity demanded, percentage change in quantity demanded, divided by percentage change in um, price. But how do you find percentage change in quantity demanded? Change in demand over demand at previous time, right? Think about it. If the demand was 1,000 units at time zero and price went down, so then demand goes up, right? So the demand is 1,200 units at time one. Then the change is 200, and the base number, base quantity was 1,000. So percentage change will be 20%, right? That's percentage change in quantity, and the percentage change in price is change in price over uh, change in price over old price at time zero. And change in price is negative, right? When price goes down, quantity goes up. So the whole fraction will be negative. That's the nature of elasticity. But we simply don't use negative. It just negative represents the direction of change is opposite, right? Direction of change is opposite. So without and we know demand and quantity demanded and price move in opposite direction. So we don't need negative, the minus sign. We just use the uh, uh, that fraction because the fraction represents the magnitude of change in quantity when there is a change in price. So it's just like that. Duration is just like that. Duration is like the sensitivity of the response in the bond price when there is a change in interest rate or yield. Okay, yield to maturity, right? So the formula will be percentage change in bond price over percentage change in yield. Uh, which can be calculated by change in bond price over bond price at time zero and change in yield. It's actually change in 1 plus y, change in 1 plus y. But think about it. In change in, when we find change in 1 plus y, actually 1 is a constant, so it doesn't change, right? 1 doesn't have any impact on change. So we only use the change in yield, okay? And then over 1 plus y. The bond price at time zero. Also, y is yield at time zero, because always change happens from the old to new. And if we rearrange it, think about it. Dividing something by a fraction is the same thing as multiplying by the reciprocal. So I simply flipped this thing in the denominator. So now it is 1 plus change in b over b times 1 plus y over change in y. And then we can rearrange, we can simply switch the denominators. So, it doesn't affect the value of this ratio, this fraction. So change in b over change in y times 1 plus y over b. But then think about it. Change in b over change in y is what? That's the essence of the sensitivity. Isn't that right? That's the essence of the sensitivity. It's the interest rate sensitivity of bond price. Okay, makes sense? I don't put it into words because words are so verbose. It will be an endless verbiage. It will be very lengthy verbiage. Like, interest rate sensitivity of the bond price. That's already a mouthful, and I'm having a hard time even projecting my voice. So simply, I don't want to speak, but simply by mathematical symbols should be able to tell a very long story, right? This simple symbol, change in b over change in y, right? And I want you to, keep in mind what it means without, making it necessary to explain it every time. Now, so basically that's duration. So duration is the sensitivity. And why are we why is it, why are we talking about the sensitivity? Because we know the change in bond price, as we talked about it in the last class, the change in bond prices when interest rate changes is actually a curve, right? A convex curve, convexity, right? There's a convexity. And the curve has different slopes everywhere. Look at the curve. D means, curve D is bond D, and the bond D has very low coupon rate, but high maturity, long maturity, and relatively low initial yield. And such a bond is very sensitive, and the sensitivity is basically captured by the slope of the curve, right? Think about it. High sensitivity is high slope or steep slope. Low sensitivity is captured by something like A. Bond A is almost flat, and it doesn't show that much, curvature or convexity. It's almost a straight line, right? And a bond like bond A has high coupon rate, short maturity, and high yield to maturity, right? High yield. Such a bond will show relatively less convexity, less curvature, right? And it will be straight line relatively. So the change in the bond price with the change in bond price with respect to change in yield is almost symmetrical. It's not exactly symmetrical, but it's almost, of all these four bonds, it's the most symmetrical because when interest rate goes down, the bond price will go up, but the increase in bond price is almost symmetrical to the drop in bond price when interest rate goes down. Of course, it's not exactly symmetrical, right? But it's the most symmetrical one of all. But other than bond A, all the other bonds show severe asymmetry, a very severe asymmetry, and then the curvature or the convexity is more pronounced, more and more pronounced, as the maturity is higher and coupon rate is lower, and as the initial yield is low. And that's why we are interested in the sensitivity or elasticity of the curve. And the elasticity of the curve is the duration. In other words, the lower the duration, the better it is, right? The lower the duration, the better it is. The higher the duration. And so that means the lower the slope, the flatter the slope, the better it is. Flatter slope means shorter duration. And you would definitely prefer a bond with shorter duration because you recover all your initial investment early on, right? If the duration is short, you recover it early on, right? And if you recover, what's the benefit of recovering your initial investment early on? Well, you will be insulated. You can be insulated from any potential future interest rate changes, right? Makes sense? Early on, if you recover your initial investment early on, then, if any fluctuation in interest rate hasn't happened yet, very good. And if fluctuation in interest rate will happen in the future, you will be relatively insulated from it, right? Your return is relatively insulated. That's why duration is important. Lower duration, right? Better. Higher duration, higher duration means it's closer to the maturity, term of the maturity. So you are more exposed to interest rate risk. So that's why, in that sense, I put it all here too, but I put it also here too. That's why duration is like elasticity. And then we have this regular duration is called Macaulay duration. Okay, Macaulay, because I forgot his Frederick Macaulay, or I forgot his first name. Macaulay is also a Canadian economist or American economist, I guess Canadian. And Macaulay basically first came up with this. And then modified duration is basically dividing Macaulay duration by 1 plus y. And why do they do that? Think about it. Duration is this, right? That's duration, right? Duration is this duration. Come on. This is duration, but then think about it. Divide it by 1 plus r. What's going to happen? 1 plus r and 1 plus y, 1 plus I, they cancel out. So eventually you end up with this. Okay? And then you can again switch the bottoms, and you can come to change in bond price over bond price. What is that? That's the percentage change in bond price, right? Percentage change in bond price. So then with modified duration, we can find modified duration simply by when we know percentage change in um, percentage change in bond price. But then, another thing is, percentage change in bond price is something we will know ex post. Okay, you understand what that means? Um, bond price will change when there is change in interest rate, right? So interest rate change causes change in bond price, and interest rate change can be predicted. It can be anticipated because we know the Federal Reserve will raise interest rate pretty much next year, sometime next year. Why? How do we know that? Well, because there's all this cry out about inflation, all this crying out about inflation, and then and then to fight inflation, to curb inflation, what do you need to do? You will need to raise interest rate, right? And of course, there's a debate whether this inflation is transitory or permanent, or or persistent. I'm sorry, not permanent, persistent. And I'm gonna that discussion. We'll put aside that discussion because um, some people even talk about stagflation, but I'm not. I'm rather on a more, uh, uh, transitory inflation camp. I mean, it doesn't seem transitory because it's persistent. Uh, but think about it. Everyone who is, willing and able-bodied are all working. Everyone able-bodied, willing and able-bodied, right? The unemployment rate is historical, almost historical low, 4.6%. 4.5% is the natural rate of unemployment. Okay, so of course there are a lot of people. They say about 3 million people retired. That's because, and that causes the worker shortage. But the people who retired, they retired. Some of them retired early, and some of them could retire early because this asset bubble, right? Asset bubble due to low interest rate for almost a decade, more than a decade, uh, increase their asset value, the value of their retirement account, retirement fund, so they could retire early. So either way, then these people are still spending because they have a very good hefty um, pension fund, retirement account. So they can they spend. I mean, if they think their retirement years, late years, will be jeopardized or threatened by loss of purchasing power and uh, uh, poor or mediocre um, retirement fund, then they wouldn't retire. But they have retired. Almost 3 million have retired. What does that mean? They are comfortable. They will be living comfortably with their retirement account. So then there is a sudden, giant, vacuum gap in the workforce. So then everyone willing and able-bodied are all working. Still, they cannot fill the job openings. They are even offering a big sign-on bonus or a lot of benefits, but still, and the people who are holding jobs are switching jobs. They are job hunting for a better paying job because those who retired or obviously in like executive positions, right? And suddenly those executive positions or upper managerial positions have openings. So those who are in the middle management are moving up. They're in a position to find better pay and higher positions. And those who are in the lower management are moving up to middle management. And those who are at the bottom are lower management are moving up to the middle management. And then there will still be a vacuum then at the bottom, right? And so everyone who is willing and able-bodied are all working. That means, and the wages are going up because they are all, they are in a good, nice position to demand higher wages. Wages are going up. As wages are going up, prices are going up too. That's another reason for it. So inflation. And with better wages, they increase spending, and as they increase spending, that fuels the prices to go up. And the prices are not only going up because of higher input cost. Higher input cost, caused by two things: higher wages and higher supply channel crunch. Supply channel crunch, right? Supply channel crunch is increasing the prices of cost of raw material, and on top of all that, wages are going up. So this is both demand pull and cost push happening together, right? This inflation is both demand pull and cost push. They talk about stagflation, but it could be there's a little hint of stagflation. Why? If you cannot fill those jobs, if if there is a worker shortage, then the output of the economy cannot grow. If the output of the economy cannot grow, the growth rate will be stagnant or low. But the inflation is picking up. Now think about it. As long as the growth rate of the economy is greater than the inflation, no problem, right? If inflation is 5%, but the growth rate of the economy, economic growth rate is 10%, what does that mean? The real growth rate is 5%, right? Also meaning that everyone's wages are on average 10%, nominally 10%, 10% bigger, 10% greater than the previous year, and in real terms, still 5% after inflation, after adjusting for inflation, still 5% better. Everyone is better off, right? Everyone's paycheck is better off, greater by 5% in real terms, in real dollars, or 10% in nominal dollars, right? Then, if that's the case, inflation is not a big deal because your paycheck is going up at a faster rate than inflation. But if the economic growth rate is stagnant, let's say economic growth rate is 5%, inflation is 5%, there is no net effect, right? Inflation is completely killing off, it's wiping out the economic growth rate, meaning your paycheck went up by 5%, but inflation is also 5%. So you are no better off than last year. You're no better off than last year. Makes sense? So they are now those who are fearing stagflation are talking about this aspect, right? Where wage increase, the economic growth rate um, isn't catching up, or economic growth rate is not or stagnating, while inflation is rampant. But by the way, I mean, I didn't want to, I digressed a little because, that wasn't what what was I trying to say? Um, yeah, what I was trying to say was, um, the interest rate change causes the change in bond price change. So um, you cannot tell what the bond uh, change in bond price is before change in interest rate, right? In other words, uh, so in other words, the percentage change in bond price is something that can be predicted, that will be predicted. Oh, and I said, we can anticipate interest rate change because we can all tell Federal Reserve is going to raise interest rate sometime next year. Why? Because of this inflation, and um, so interest rate change is predictable. So when we can change, when we can predict the interest rate changes, right? Then uh, we can predict the percentage change in bond price. Make sense? So how do you then predict the a percentage change in bond price? If you know the duration, and the duration can be calculated from the past bond price and interest rate data, right? Duration can be calculated. Um, so we have duration, and think about it. Then we solve this duration formula um, in reverse. In other words, duration is change in, we can rewrite this as like this: change in bond price over bond price times 1 plus y over change in y. And then solving this for uh, this, solving d equals this for this. In other words, this is the unknown now. Then what do? This z equals x times y structure, z equals x times y structure. So if you do, if you want to know what x is, then what do? Z divided by y. Okay? I just hope you don't get confused, this y with that y. In general, what I'm talking about is um, the, general structure of uh, only 4 people. This is what's going on. This is a disaster. Let me use. Okay, what I'm talking about is if you can identify this structure, right? Solving for x is simply z divided by y. Isn't that right? So our duration is basically what? Change in bond price over bond price times 1 plus y over change in y. You all know delta. Delta is the symbol for change, right? Delta is the symbol for change. Then we can solve this equation for percentage change in bond price, right? And if we solve for that, then you will simply divide duration by 1 plus, and that, we know dividing by a fraction is the same thing as multiplying by the reciprocal. Right? So everyone is okay with that. This is, how we use, uh, duration to find the percentage change in bond price, percentage change. Okay? And then let me get back to okay, my connection is poor. So therefore, and then if you want to find only, so that's, percentage. And if you want to change only the, if you want to find a change in bond price, only, how much the bond price will change, then that means, three dots, those, triangular shaped three dots, that means therefore, right? Therefore, change in bond price is duration times, right? You will need to multiply this to the other side. Bond price times, right? Change in y over 1 plus y. Also, if we use modified duration, the change in bond, the percentage change in bond price, because modified duration is like this. Modified duration is change in bond price times 1 over change in y. So using modified duration, then percentage change in bond price is simply modified duration divided by 1 over change in y, which will be modified duration times change in y. Okay? And then change in bond price only, then is modified duration times, right? Bond price times change in y. Okay? So everyone is good so far? Everyone is following so far? Any questions?
I'm with you.
Okay, great. Anna, I can always trust you. I can always trust you. Um, always reliable. All righty. So then let's do the example 2. Where is it? Okay, this one. I want you to download it from, it's all there. Course. So it's very slow at my end, but I told you last time to download all those files. So it should be, you should have it on your computer already. You should have it in. Right? Here, like, it's spreadsheet 11-2. Okay? So Do you have it with you? I mean, it would be when you open it, it won't. It will be all blank. I mean, other than the initial um, input data, it would be all blank. Actually, I shouldn't even highlight those because that's initial input data. So I want you to make some. Uh, I want you to make some changes. Um, so all of these highlighted cells should be. Uh, all of these highlighted cells should go away. Delete all of the highlighted cells. Okay. Delete all the highlighted cells. Oh, no, 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 no. What did I do? Leave the highlight. Just delete the data, things in there because we need. Okay. And you may find I have extra rows. So I want you to add in extra rows, right? The first one is so that would be bottom two rows. Originally you had Macaulay duration and modified duration, but right below Macaulay duration, I want you to insert one row, and then below modified duration, I want you to insert two rows. Okay, insert two rows. And if you have deleted everything, right? Um, I guess we'll have to do this in after the break. But please get it ready, right? Before we start, please get it ready. And there are three bottom tabs. Three bottom tabs. Uh, it's the third one. So please, go to the third bottom tab. It says modified by 1 plus y. That means modified duration by 1 plus y, but it's not only modified duration. So let's take a 10-minute break. It's 6:57. The present time currently.
Professor,
Yeah, yeah,
can you leave it on the screen so I can
yeah,
take
yeah.
this?
I will leave it on. Yeah, I will leave it
Okay.
on the screen. Okay. So we'll reconvene at 7:10. Okay, reconvene at 7:10. I will leave it on the screen. Don't worry about it. I'm just gonna mute. All right, we're back. We're back. Now we're back. Um, so let's continue with this exercise, right? So here, column A is, column A is, a bunch of variables. First of all, yield to maturity, right? So it's basically, like this, coupon rate, right? Yield to maturity is Y, right? So, and change in yield to maturity, I'll put it as Y because uh, that would be easier to recognize, right? Maybe, Y will be a better uh, yield to maturity, right? So here we have a coupon, right? Here we have a coupon with a coupon rate of 8%, right? The coupon rate of 8%, and yield to maturity of 9%. So we can already tell we can already tell what type of bond this will be. In other words, we can already tell whether it's going to be a discount bond or um, premium bond, right? Can anyone tell me this is going to be a premium bond or discount bond? Can anyone tell me? Anyone is there?
I'm here. I'm thinking.
Yeah, yeah.
So would be discount.
Yeah, it will be a discount bond. Yes, because the coupon rate is lower than the discount rate. Yield to maturity is basically the discount rate. If it is lower than the discount rate, uh, and that's basically the criteria for a premium bond and discount bond. Um, if the coupon rate is lower than the discount rate, uh, it's going to be a discount bond. If otherwise, coupon rate is greater than the discount rate, it's going to be a premium bond. So it's going to be a discount. And so, Anna, you'll get 0.25 for that, 0.25. We can tell it's going to be, but that's not what we are, interested in at this time. Coupons per year, that means number of coupons, just one. And we are predicting, that the interest rate will change. It will go up by 0.1%, right? And then from this to it will change. It will go down by 0.005. So to make it easier, let me put everything in percentage. Now maybe I don't. It's better not to put it into percentage because then this one will be percentage point, not the. So then this is change in yield to maturity or interest rate. So we can easily find it like this, right? And then you drag it to the right. You drag it to the right. Let's say, and nothing here. You drag it to the right. Okay. So basically, this is basically time zero, time one, right? Time two. This is the interest rate at time zero, time one, time two, and we are predicting that the interest rate will change like this. At first, it will go up by 0.1% and go down by 0.05%. And here's the bond prices. I mean, these bond prices are simply, how do you find a bond price with no coupon? I mean, we know coupon payment, we don't need that. You can find it, right? Because we can generate from the coupon rate, we can tell each coupon payment is $80, right? So whether we have it or not, it doesn't really matter. And besides, here I used the price function, right? I used the price function. And if you use the price function, first settlement date, and you're not a beat, you're not a settlement date, which is the date, the date of purchase, the date you buy the bond, and then maturity date. So this is a 30-year bond, 30-year, right? And then rate means coupon rate. So I entered coupon rate, and then I lock them all. I need to lock them all, right? I had to lock them all. And then yield is the yield, right? So initially yield is 9%, B5. And then redemption value. Redemption is the maturity value of the bond, and you have to use this formula, all the bond price must be expressed as percentage of the par value, percentage of the par. So redemption value is 1,000, right? But instead of putting 1,000, we put 100% of 1,000. So 100%. That's so 100, and then frequency once a year. You enter that and lock it, and then this will give you. Yeah.
Is there ever like an instant the redemption wouldn't be 100?
No. Redemption value is always 1,000. Redemption is the face value of the bond is 1,000. So it is 1,000. And I just explained to you, we just need to put 100 because using price formula or yield formula in Excel, you will have to, all the prices must be expressed as percentage of the par value. So that's why I entered 100, right? Otherwise, the formula doesn't work, right? It has to be the percentage of the par value. So there is no instance of the redemption value being 100. I mean, back in 1940s, right? Probably around until 1940s, the face value of the bond, there was a time when the face value of the bond was 100. But that was like, 1940s. And even probably until like 1960s, but then after 1970s, no, face value of the bond is always 1,000. Okay, the face value, maturity value, par value, redemption value, it's all 1,000. Okay, except a municipal bond, right? Municipal bond, only municipal bond has $5,000 face value. Okay. All right. So then this way, that's the bond price, right? And then I dragged it to the right. Because by dragging to the right, the bond price, every other inputs are the same. It's only the different yield, right? Different yield to maturity. So I got the bond price like this. And then the change in bond price, not a difficult thing. Change in the bond price. Minus, right? And then you will drag it to the right and get a change in bond price. Of course, the bond price, when the yield, the interest rate went up, bond price goes down, but the interest rate goes down, bond price goes up, right? So negative change, positive change. Now, we can find, percentage change in bond price. It's literally percentage change, right? Percentage change. So then change in bond price over bond price at time zero, original bond price, right? And then if you drag it to the right, this is the change in bond price, the previous bond price, right? Over previous bond price. So we got change. So then let's go down to Macaulay duration. Let's go down to the calculation of duration. We're going to come back to the rest of them later. Duration. Let's calculate duration using Excel's built-in function. I'm going to do that later. So let's calculate Macaulay duration using 1 plus y. Remember, that is the formula, right? Let's try to, I can't. Oh, I can put them side by side. This is the problem. I cannot put them side by side. See, I thought I could put them side by side. Oh, then I can, yeah, this is what I can do. Oh. Yep. Yes. Oh, no. Okay, I can put it side by side like this. So, there's only up to column D. So if I find Macaulay duration by, you see, the duration. Okay. So duration by, using 1 plus y, right? First, not there. It's not there. It should be here. So is change in B over B, right? Which is this, right? Percentage change in bond price times 1 plus Y plus Y. The Y in here is the old, it has to be the old old Y, old, interest rate, not the before change, not after change, right? Divided by change in Y. This is the change. Okay. We hit OK. And then this needs to be expressed in positive. It is already negative, so it must be expressed in positive. And then, if that is the case, then if we drag it to the right, that's okay. We don't need more space there because there's no more column. All right, and then so let's verify that by function, right? Because Excel has modified both, Macaulay duration and modified duration function built into that. And so here, insert function, this should be financial. So you scroll down, okay, here's duration. Duration is Macaulay duration. And it's asking for, okay, let me do it here. This is like, generic duration, because without any change, without any change in price, change in yield assumed, right? So we're gonna, again, duration. Just give it settlement date. Settlement. Here is the settlement. Maturity. Here is the maturity. Give it what it's asking for. Coupon rate. Coupon rate is 8%. Yield. Yield is 9%. 9%. Frequency. How many times does it pay coupons? Once a year, right? And there you go. Once a year. Hit OK. Yeah, we came close, but again, this is basically without. This is when no interest rate change is given, but just like just measuring, estimating generic duration. Okay. And here I would like to lock a couple of things, because these input data like settlement date, hit F4, maturity date, hit F4 to lock, coupon rate, which is B4, all right, lock. These things don't change. B5, it will need to change, right? B5 is the, but then B7, it's locked. It should be locked because coupon rate, coupon payment, number of coupon payments a year. it doesn't change. So you hit enter, and then I can drag it to the right, and then yeah, we got something closer, right? We got something closer with when yield to maturity changes. Is this whole? I guess I will. This cannot be done. So all right, I'll have to. This too, yeah, it needs to be a full. And then let's think about the modified duration using 1 plus y. And because in modified duration, we have two versions, right? Remember that? Um, in modified duration, it's just duration over 1 plus y. So it can be like this, right? Which is, which is this, right? I mean, I can recycle Macaulay duration and divide it by 1 plus y, or I can use this, right? Makes sense? Or I can use this. I can use this. Okay. So let's find modified duration using. So we have Macaulay duration, and we divide it by 1 plus y. So here's y, right? Then I drag it to the right. Okay. And then if I use change in y, right? Delta y, then it's going to be change in b over b times change in. Okay. So it's going to be, we have change in b over b times 1 over, then change in y, so we'll multiply by 1 over y, or divide it by y. Okay. So change in b over b, which is a percentage change in bond price, and times, or divided by change in yield. There you go. I'll need to put negative. I'll need to put minus sign so that this will come out as positive. But we know this is only the magnitude of change, and the direction of change is opposite. And I drag it to the right. Okay, I found modified duration. But let's find modified duration also by Excel. So go to a function and then scroll down until you find modified somewhere M duration. M duration, that's modified duration. Hit OK. Give it what it's asking for. Settlement date, maturity date, coupon rate, yield, compounding frequency, 1 a year. And then I'm gonna hit OK, and this is what I got. And this is kind of generic, right? Before any change in interest rate. And I will need to lock a couple of things. I will need to lock something like, hit F4, right? Settlement, maturity date, coupon rate. But B5, you don't. B7, yes, lock. Hit enter. And that way I can drag it to the right. Yeah, we come to very close numbers. I mean, this small discrepancy is due to um, uh, small differences in formula, and especially Excel's built-in function has settlement date and maturity date. So there's a not fundamentally, but there was a slight variation or variant, right, in the way it is calculated. But the durations, they are very close, pretty much. However you calculated it. The difference is only in second decimal place, in 100th, right? In 100th. That's pretty. Now, then here, duration is not the goal. The goal, duration is a tool. Tool for what? Tool to predict the price change, right? It's the duration is the tool to predict the price change. Why? What did I say? Price change when interest rate is expected to change, the price hasn't changed yet. Price will change in the future as the interest rate change is predicted. So if we predict the interest rate to change in January of 2022, then the price change will happen. The price will change in January 2022. I mean, of course, it will start to change already slowly prior to that, because um, as people anticipate price change, they either sell or buy bonds. The price will start to change, but the price will consummate. The price will consummate its change, right? Change will be consummated when the interest rate finally changes, right? So if it is predicted, we don't know the price. You understand? If the interest rate change is predicted, um, uh, uh, we don't know the price yet. And of course, we can calculate it. We can but again, this price will take effect. This price will be the price as of January of 2022, right? When the interest rate has finally changed. So, but using duration, we can forecast or predict the percentage change in price and dollar change in price, right? So if you use a Macaulay duration, predict, right? And if you use modified duration, predict, or rather, I would show like uh, okay. modified D star. So then we know, since we know duration, right? How do you find the percentage change in price? We already have it, but let's predict it. Let's find it by duration, right? It's duration times change in yield over 1 plus y. Okay, so Macaulay duration is here, right? Macaulay duration. I can use this. I can either use this or use this, but let's use this. Okay, let's use this. So duration times and over, I mean yield over, change in yield over 1 plus y. Right, the formula is duration times change in yield over 1 plus y. So change in yield is here, right? Over 1 plus y. That y is this thing, the old y, the previous one, right? I guess I don't have to put it here because, anyway, in multiplication, it gets multiplied only to the numerator. So hit OK. Why was it? Oh, the duration was originally negative, right? Duration was originally negative, but I gave, right? I try to make them all, positive. So I will need to put a minus sign to make it negative. And then I can drag it to the right. And we are pretty much getting, it's very close, right? And then what about, change in price by modified duration? Percentage change in price by modified duration is modified duration times change in y. So the modified duration, where is it? I'll use, modified duration calculated by Excel. Modified duration times change in y. Change in y is here. Of course, I will not forget, right? You should not forget putting a minus sign there. So yeah, it's quite close. Modified duration or Macaulay duration, quite close. And when I actually did, percentage change in price, it gave me, it's close. The difference is, 1/100th of a percentage point. So it's, 1/100th of a percentage point. Now I drag it to the right, and yeah, so got modified duration, right? Percentage change in price by modified duration. And then let's find the price change by Macaulay duration. and price change in modified duration. So here, by Macaulay duration change, you simply need to multiply this to the right-hand side, b. So d times b times, right? So in other words, we already have, we already have d times change in y over 1 plus y, which is, this. Isn't that right? Which is, a percentage change in bond price. So we multiply that by bond price, then we will get, change in bond price. So we have this, then times, first times bond price, that should be, old bond price, There you go. Yeah, exactly. 9.28 negative, right? That means, it goes down. And 4.26, exactly, right? And then what about the bond price change by modified duration? We already have this. We already have this. So it's simply modified duration times b, right? In other words, this times b, right? So here, percentage change in bond price times let me just make sure. Yeah, this change by Macaulay modified duration, right? That is, so not C12, but this times B. There you go. And then you drag it to the right. No, not move, but drag. Copy and drag. Okay. This, I think I should have done, okay, C12, no. The percentage change in bond price by Macaulay duration. It is this times B10. There you go. Okay. Oh, okay. So there was a slight difference, but we find basically okay, compare that. Oh no, what's happening? This is, basically prediction forecast of bond price change, and it's quite very close, right? Simply from of the bond prices, we can, finding bond price change 9.28, 9.30, by Macaulay duration 9.30, by modified duration 9.29 is quite close, right? All right, so everyone good up to this point? Is everyone good? Hmm?
Yeah.
Okay, good, good. So, if you are, if you are okay up to this point, then uh, it's about again 7:50. So time to take a break. Let's take a 10-minute break and reconvene at 8 o'clock. Okay, let's reconvene at 8. Okay, I just wonder what's going on with the rest of the people. Okay, I'll just leave it on. I'll just mute. All right, we're back. We're back. Um, so yeah, the exercise. The exercise was fun. Um, and the next is, what determines duration. This is something you can read. Of course, it will take. It's more than what matters is how to use duration to predict the bond price change, right? How much it will change in percentage and in dollar price. So, what determines duration? This will skip. And this graph is really capturing all the molecules rule 1 through rule 5, right? Um, basically, look, this is maturity. Of course, between duration and maturity, there is some positive correlation. The longer the maturity, the longer the duration, right? Um, and between duration and maturity, there's a one-to-one correlation in zero coupon bond. But depending on then the rest of them, think about it. If duration drops drastically, right? It's a 30-year bond, but the duration drops drastically for something like duration drops basically below 7.67 years, the lowest duration, right? When coupon is high and yield is high, right? But then the duration next to that, the duration falls below 10 years, right? 30-year bond, but maturity 30 years, but the duration is pretty much like below 10 years. The coupon is low coupon, but high yield to maturity. Um, high coupon but low yield. We have then maturity is like 13 year. Duration is like about 13 years. But the duration increases with the maturity, right? So this captures very well, the correlation between the duration and maturity, right? Under high coupon, low coupon, high yield, low yield, right? Scenarios. And also, this captures well. As the coupon rate increases, right, for the same maturity, duration falls, right? Duration is low, right? And the perpetuity, duration of the perpetuity, I think I should have, I should have done this. I think it was summary. Yeah. Here's an example of how to use duration to predict the change in bond price. Maturity is 30 years. Coupon rate 8% annually, right? Paid annually. Yield 9%, right? Bond prices originally at time zero, 897.26. Duration 11.37 years. So if yield increases to 9.1%, change in bond price. Well, actually, I think this example is what we did here, right? The only difference is that the duration was given. So let me put it back to normal view. I put it back to normal view. Macaulay duration 11.3738. Yeah, that's the duration they gave in this example. right? 11.37. So the bond price will change by how much? $9.36. $9.36. It will drop. Yeah, that's what we got. 9 point, actually what we got, 9.28, 9.3, because we used, more precise duration. Okay. Um, and then here, okay, this is the thing. Duration of perpetuity. Duration of perpetuity. You know what perpetuity is? Um, it's perpetual annuity, right? It's like annuity, but it doesn't have, so it's not bond. Bond is an annuity, isn't it right? It has maturity, so it stops. But perpetuity goes on forever, right? So if it is a perpetuity, the duration is 1 plus y over y. Okay, 1 plus y over y. So yield to maturity is 15%. In other words, discount rate is 15%. Payment is $100 annually. $100. Perpetuity pays uh, constant dividend or constant uh, payment. So $100. Um, when we price it, it's going to be 100 over 0.15. But in duration, 15%, so 1.15 over 1.15 comes to 7.67 years. Comes to 7.67 years. So here, 7.67 is the duration of perpetuity. It goes in forever, right? But the duration of something like this, 15% coupon rate, yield to maturity 15%, um, right? The duration, uh, yes, I calculated it before, but this is 15% coupon. It's better than 10% coupon, right? Remember, this perpetuity is paying 10%. How do I know 10%? $100 is 10% of 1,000, the face value, right? So it's 10%. I mean, even the perpetuity with the same discount rate or same yield, the perpetuity with 10% coupon rate, its maturity, its duration is 7.67. Then if a bond has better coupon rate, 15% coupon rate, its duration should be below 7.67 years, right? Makes sense? Now, so now we come to immunization. What's an immunization? We know what's immunization, right? You take a shot, how to immunize yourself, right? So then, what is immunization in terms of bond? In case of bond, immunization is matching. You have obligation to pay. You have liability, right? You have liability to pay in the future, and you have assets, right? You have assets to fund that liability. So in other words, if you have payment to make in 5 years, right? How do you raise fund? How do you come up with the fund to make that payment in 5 years, right? So you will pay it with assets. So that means your assets in 5 years must be equal to your payment obligation. Your assets must be in 5 years must be equal to your assets. Your liability obligation, right? Your liability. If you have a payment to make in 5 years, let's say that is $100,000, then uh, in 5 years you would also have to have asset that would have uh, equal value as, in other words, $100,000, right, to match your liability. Then how do you ensure that you will have that $100,000? You will put into you basically in buy bonds, invest in bonds that pays fixed income, right? Of course, coupon is fixed income, and then at the end, you will have the face value. So altogether, it should come to $100,000, right? But how do you then match exactly, that by year 5, at the beginning of year 5, in other words, uh, if you if your payment obligation is, let's say, at the end of year 5, I mean, if you have uh, your liability your liability matures in 5 years, right? The liability matures in 5 years. So your timeline is 5. Starting from time 0, 1 is the end of year 1, 2 is the end of year 2, so 5 is the end of year 5. Then at the end of year 5, you have to pay $100,000. And then uh, uh, you prepare those $100,000 by investing in bond today, so that at time 5, all your future value of the bond will be equal to $100,000, right? So then your payment obligation is, or your liability is, immunized. Make sense? Your liability is immunized. Okay, does that make sense? So let's take a look at this example. Um, so it's a strategy to shield net worth from interest rate fluctuations. Yes, because uh, you may never know, because over 5 years, if interest rate fluctuates, right? Uh, of course, your bond will pay fixed interest, coupon interest, so it won't be affected. But the present value will be affected by fluctuating yield. So basically, you need to match the duration of assets and liabilities, right? If the duration is the same, then you will have the same amount of assets as liabilities. So for a horizon that is equal to portfolio's duration, for the time horizon, right, which is equal to uh, for the time horizon of the liability, that is equal to your asset portfolio's duration, bond price risk and reinvestment risk are precisely offsetting each other, right? And I will show you what it means shortly. So table 11.4, GIC immunized by bond with duration of 5 years. GIC means guaranteed investment contract. Okay, table 11.5.4. I believe this is table, yeah, table 11.4. What is it talking about? So insurance company issues guaranteed investment contract, right, for 10K with maturity of 5 years and interest rate of 8%. So what does that mean? Insurance companies sells products such as GIC, meaning that they take 10K from you and they guarantee 8% interest with maturity of 5 years. So then in 5 years, your payment obligation is the future value of this 10K, and that 10K times 1.08 raised to 5. It's going to be 14,693, right? So this is your payment obligation in 5 years. So you took 10,000 from the customer, the client. So you will need to have, from this 10K, you will need to have at least more than or equal to, right? The future value of the bond. And so you invested in a bond, and the future value of the bond at year 5 must be at least equal to this amount, your payment obligation. Okay, so what the company did is they put the 10K into 8% annual coupon bond selling at par value with maturity of 6 years. That's your asset now. But then you might wonder, what if the maturity if the coupon rate is only 8%, then if the coupon is all reinvested also to 8%, 8%, if the coupon is reinvested at 8%, it will only be in year 5, it will only be this. I mean, they're not making anything at the end of year 5. Yeah, theoretically, if the interest rate doesn't change, it will be exactly this. Of course, then what's the point? Of course, this insurance company will invest it in something that will pay better coupon rate, and then they will have something left. They will have something left over. But again, let's assume, this is the worst case scenario. But then why is the maturity 6 years? I mean, isn't the maturity it's not the maturity. Maturity can be different. What matters is the duration must match. Duration. So in other words, the duration of this bond portfolio will need to be 5. Okay? So now, if you think about it, this GIC at the maturity will have 4 coupons reinvested at 8%, right? I mean, at the maturity of this GIC, at the maturity, which is 5 years, at the end of year 5, your assets will have 4 coupons reinvested at 8%. And the future value of all those cash flows will be, if it is reinvested at 8%, will be 4,693. I mean, you can do it by, you can simply calculate it. Let me show you. It's just annuities, right? So Where do I put it? I think I should put it. I think I did it here. This is what I did. But this is when it changes. Without change, I think I should put it. Yeah. So yield is 8%, coupon rate 8%, maturity is 6 years. This bond has maturity of 6 years, right? Um, the market price of the bond. So first, this is duration, calculation of duration. So it's not showing you exactly. Let me build it here. What I should do is payment first. First, maturity value or future value or face value, right? The same thing. And coupon rate. Coupon rate. I'll just leave it like that. I don't have time to. And then uh, yield. Uh, and then compounding frequency, and then uh, let's write future value of all of those, and then present value of the bond price. Okay. Okay. So basically, maturity value we all know it's $1,000, right? Coupon rate 0.8, 0.08. Uh, and yield also 0.08. $6. What's happening? It's like this. We assumed once, so we don't need this anymore, but that's fine. Uh, me put it here. Okay. 6 years, right? But in our timeline, we want to have, we want to see, in our timeline, we will have only 5 because, um, anyway, let me give 6. So I think I do. And -1. T minus 1. Okay. So you see T terminal time, that's the maturity of this bond, but we want to find first, future value of payments at the end of year 5. Okay. T minus 1 is this minus 1. Um, this is, simply the future value of annuity. So I'll simply use Excel's future value. Just give it coupon rate here, end periods 5, payment 80, but this will have to go in as negative. For this one, no. This is, wait a minute, future value, here. And payment. So this will go in. Actually, okay. This was 10,000, right? Not 1,000. So 10,000. Then we got, future value of all those coupon payments will be this. And that's what this is saying, right? Um, uh, future value of all those coupon payments will be this. And with maturity value and cash flow in year 6, right? With 1 year left to maturity of 6 years, the price of the bond must be exactly 10K. Yes, I can show you. The bond price must be exactly at year 6, right? Again, so I'm going to have to find price. But we don't have much time, so I'm gonna rather show you the table 11.6. So this is what it is saying. If the interest rate remains at 8%, right? All those $800 coupon payments, the first one will, because you're getting paid at the end of the year, the first one will earn interest 4 times, right? By the end of year 5, it will earn interest 4 times compounded. So it's going to be this. Second 800 is going to be this. Third 800 is going to be this. And so the fifth 800 will still be 800 because it's not getting compounded. But with 1 year left, we have 1 year left to maturity, right? We are at the end of year 5, and this bond portfolio has the maturity of 6 years. So we have 1 year left. So at that point, at the end of 5th year, at the end of year 5, and at the beginning of year 6, the price of the bond will be exactly, this bond portfolio will be exactly this, because at the end of year 6, you will receive the face value or maturity value of 10K and the final interest of 800. And it should be discounted once to year 5, to the end of year 5, because, right, you understand? Because this is the cash flow to come at the end of year 6. So when we are standing at the end of year 5, this must be discounted 1 year back. And if it is discounted by 8% exactly, it will be exactly, right? The present value at the end of year 5 will be exactly 10K. So then, if you add all of them up, it's going to be 14,693, right? Does that make sense? So that means we will have exactly the right amount of money ready to pay our investors, right? In other words, we can meet our payment obligation. Our assets can meet our liabilities, right? But then when interest rate falls to 7%, if interest rate falls to 7%, but then, look, all the coupons will be worth less. The future values of the coupons will be worth less because it gets reinvested at 7%. So it gets compounded by 1.07 raised to 4, raised to the third power, and so on, right? But think about it. When interest rate goes down, present value goes up. The present value of the face value, or the maturity value, and the final $800 coupon payment will be discounted by a lower denominator, smaller denominator. So the present value here means not the present value at time 0, but the present value at time 5. Okay, you understand? Because time 5, end of year 5, is the time when we have to pay out to our GIC investors. So then we will have 14,694, which is $1 better, $1 more, slightly $1 more than our obligation, right? So you see what's happening here. If the prevailing market rate falls to 7% or yield falls to 7%, then all these future values of reinvested coupons will be smaller, but then because the present value of the final the present value of the face value of the bond and the final coupon payment will be greater. Um, in other words, the net effect is we're still fine, we're still good, right? Our assets can meet our obligation. What if interest rate goes up to 9%? When interest rate goes up to 9%, all of our future value of the coupons will be greater, right? Because they are all, reinvested at higher rate, right? But then our face value of the bond and the last coupon payment gets discounted by a greater number, right? By a larger denominator. So the present value of that will be smaller. Again, present value, this is not present value as at time 0, as of time 0, but the present value as of time 5. Okay? Because year 5 is when we have to pay out. And then, since this one, the coupon payments, future value of the coupon payments increased, although the present value of the bond went down, it more than offsets that difference. So we end up with 14,696, which is actually like $3 better than our obligation, our liability. We're still covered. So what does this tell you? We don't know. We don't know whether how interest rate will behave. I mean, we can make a forecast for the short term, like within 1 year or within 2 years, but not deep into the future, like 5 years, 6 years. So it will be a problem when we have a long-term payment obligation, right? Because if there is an interest rate fluctuation beyond our expectation, our asset value may not, right? Our asset value may not be sufficient to cover for the payment obligation, our liabilities. But if we match the duration, of liabilities and assets, then we are immunized, right? Our portfolio is immunized. So that's what is meant by duration matching. So here, the duration of our bond is 4.99, right? And the duration of our payment obligation is also 4.99, right? So that is duration matching. I mean, I'm sorry. It's a zero coupon. Our payment obligation is a zero coupon bond, so its duration is the same thing as the maturity, which is 5 years. And the duration of our bond portfolio is 4.99, which is about 5 years exactly. Almost 5 years, right? 4.99 is almost 5 years. Okay, does that make sense? I found the duration by that weighted average method. Also found duration by Macaulay and Macaulay duration. And this is, I found it also by this method, which is quite by this formula. All come to the same conclusion. Okay. Alrighty. Any questions so far? Any questions?
No, Professor. I think I'm good. Thanks.
Okay, very good, very good. At least I still have I still have three people hanging in there. Alrighty. So if you don't have any more questions, then that's it for today, or for tonight. Uh, uh, I will, see you guys next Thursday, and next, I think tomorrow there will be announcement going midterm three. Yeah, it will go out probably tomorrow, or but then of course, it's not gonna start tomorrow. It's not that the announcement is always in advance, so just look out for the announcement. Okay. All righty. Have a good
Sounds good.
night.
Take care,
All
Professor.
right. All right.
Take
Take
care,
care, everyone.
Professor. See you
All
Saturday.
right. You too. You too. All righty. I'll stop sharing and